Lens episode titled Bank Confidence. Periodically we'll read in the news where there's a bank problem, a bank had to be closed down because regulators came in, the banks were insolvent, and we had a couple of those in the news just recently, and many folks are wondering, what's going on? Is my money safe? What's going on in the economy? Should I be concerned? Should I be worried? So let's take a look at what has happened in this particular instance with Silicon Valley Bank. As you may know, Silicon Valley is a high-tech area in California. The tech industry has gone through many changes. Many tech companies moved out of California. The whole industry, or that part of the business community, has gone through some rough times. And when that happens, companies will often experience profits, lower cash flow. They may need to rely more on their deposits to pay the obligations, whether it's business expenses or payroll. And that's what happened with the Silicon Valley Bank. They had to pay out a lot in deposits, and there was, in essence, on the bank, and the bank didn't have enough reserves, enough resources to pay the depositors, and the regulators came in and closed down the bank. Well, how does that happen? Well, when you look at banks, the way they work is they get deposits, they lend money, they make a profit, they make a spread on the amount that they receive from their money that they lend out compared to the deposits, and that's where they make their profit. The problem or the question is, how are they investing their money? What is the amount of risk in their investments? Well, banks are fairly conservative, so this particular bank made quite a few investments in U.S. Treasuries, and you may know that's a fixed instrument. And the way fixed instruments work, and we talked about this numerous times in the Financial Lens episodes, is that when interest rates go up, fixed value accounts or fixed investments go down in value. It's true of bonds, it's true of U.S. Treasuries, and the reason for that is when interest rates go up, no one wants those bonds or those treasuries that are paying less because you can get better rates elsewhere. So folks will say, well, I thought that bonds are fairly safe. I thought U.S. Treasuries are safe. They're safe if you keep them to maturity. You'll get what you paid for them. But if between the time you bought them and the time you sell them, interest rates go up, they will be worth less. So when there was a run on the bank, they had to sell off these investments. They had to sell them for a loss. They weren't worth what they originally invested, and they simply didn't have enough money to pay the depositors who were collecting on their bank accounts. So the government stepped in. They said they'll make all the depositors whole. FDIC is the regulatory body that controls this, has a limit of $250,000 per depositor per bank, and they agreed to make that an unlimited amount. The reason for that is because they knew that if there was consumer lack of confidence, there might be a run on banks across the country, and if that were to happen, we'd have a financial debacle like we've really never seen. So the regulators came in to make depositors whole, and those depositors in the Silicon Valley Bank are made whole. But the question is for folks like yourself, what should you be doing with your money? Well, if you look at banks, they are FDIC insured, but it's up to $250,000. So you probably want to reduce your holdings to $250,000 per depositor, per owner, per bank. That'd be a wise thing to do. Other folks say, what about my other investments? Are my other investments safe? Well, if you have bonds, they will be subject to interest rate risk. When interest rates go up like they did last year, bonds lost 15% and you could lose that value. Folks ask, what about my annuities? What about my insurance products? Well, the insurance industry is a little bit different than the banking industry. In the insurance industries, regulators require that the insurance companies have a 5% excess related to how much they owe to policyholders. So for every $100 that insurance companies and annuity companies owe depositors or their policyholders, they have to have $105 on account. They have large reserves. So even if there was a run on the annuity companies, on the insurance companies, they would still have a 5% excess above and beyond all the monies that they would pay out to their policyholders if everything was cashed out. So the monies that you have with insurance companies are safe as long as the company is financially sound. We don't have to be worried. We do not have to worry about a run on the insurance companies, but with banks, it may be wise to limit your investments to no more than $250,000 per bank. Thank you for listening to the Financial Lens episode titled Bank Confidence. If there's any way we can serve you, if you have any questions, it's our privilege to serve you any way we can. Thank you for listening.